You just hit 70% win rate this month. 7 out of 10 trades were winners. You're feeling good. You're feeling confident. You're already thinking about quitting your job. But then you check your account balance, and somehow you're still down money. How is that even possible? You won most of your trades. You did everything right. You followed your setups. You stuck to your plan. So why is your account smaller than it was last month? Because you're obsessing over the wrong number. You think win rate is what matters. You think hitting more winners than losers is the goal. And you're dead wrong. Your win rate means absolutely nothing if your risk-to-reward ratio is garbage. You can win 80% of your trades and still go broke. You can win 30% of your trades and get rich. The difference isn't how often you win. The difference is how much you make when you win versus how much you lose when you lose. That's your R ratio, and it's the only number that actually determines whether you make money or lose money in this game. Let me show you exactly why you've been lied to about win rates. Everyone talks about win rates. Every trading course, every guru on social media. They all brag about their 75% win rate, their 80% win rate, their 90% win rate. It sounds impressive. It feels good. Who doesn't want to win most of their trades? But here's what they don't tell you. Here's what they're hiding behind that shiny win rate percentage. The math doesn't care about your feelings. Let's run the actual numbers. Let's say you're a trader with a 70% win rate. Sounds great, right? Out of 10 trades, you win 7 and lose 3. Now let's say every time you win, you make $100. And every time you lose $300. 7 wins at $100 each, that's $700. 3 losses at $300 each, that's $900. You just lost $200 even though you won 70% of your trades. You're a winning trader who's losing money. Now let's flip it. Let's say you have a 30% win rate. Sounds terrible. Out of 10 trades, you only win 3. You lose 7. But this time, every time you win, you make $500. And every time you lose $100. 3 wins at $500 each, that's $1,500. 7 losses at $100 each, that's $700. You just made $800, even though you only won 30% of your trades. You're a losing trader who's making money. That's the power of risk to reward. That's why obsessing over win rate is a trap. You can lose more often than you win and still be profitable. You can win more often than you lose and still go broke. The only thing that matters is the relationship between your average winner and your average loser. But here's where it gets tricky. Here's where most traders completely mess this up. They know about risk to reward in theory. They've heard about it. They've read about it. They might even say things like, I only take trades with a 2-to-1 risk reward. But then they get into a trade and everything falls apart. They set their stop at $100 and their target at $300. Perfect 3-to-1 risk reward on paper. But then the trade starts moving against them. It hits $80 in losses, and they panic. They think maybe I'm wrong. Maybe this setup isn't working. Maybe I should cut this before it hits my full stop. So they exit at $80 instead of $100. They just reduced their risk. Now their stop is $80 instead of $100. But their target is still $300, right? Wrong. Because now they're in another trade and this one's going in their favor. It's up $200, and they're excited. They're thinking this is great. I'm up $200. I should lock this in. What if it reverses? What if I give it all back? So they take profit at $200 instead of waiting for their $300 target. Now look at what just happened. Your risk went from $100 to $80. Your reward went from $300 to $200. Your risk-to-reward ratio just went from 3-to-1 to 2. 5-to-1. And this happens over and over and over. Every time you cut your winners short, every time you let your losses run a little longer, you're destroying your risk-to-reward ratio. You're turning a winning system into a losing system. Not because your setups are bad. Not because your analysis is wrong. But because you're sabotaging your own math. So why do we do this? Why do we cut winners short and let losers run? Because we're wired wrong for trading. Think about it. You're in a winning trade. It's up $200. You're feeling good. But there's this nagging voice. It's saying take the money. Lock it in. A bird in the hand is worth two in the bush. Don't be greedy. What if it reverses? That voice is your survival instinct. That voice is trying to protect you. In the real world, taking a sure thing over a potential bigger gain makes sense. But in trading, that instinct kills you. Because trading isn't about individual wins. It's about the long-term math. Cutting your winners short feels good in the moment, but it destroys your profitability over time. Now flip to a losing trade. You're down $80. Your stop is at $100. That same survival instinct kicks in, but this time it's saying don't accept the loss. It might come back. You're not wrong. The market is wrong. Just give it a little more room. Just move your stop a little further. Taking a loss feels like failure. It feels like admitting you were wrong. So you avoid it. You rationalize it. You give it more room. And then you're down $150 instead of $100. Your risk-to-reward ratio is destroyed again. Not because you didn't know better, but because your emotions overrode your logic. Here's what a real risk-to-reward system looks like. Before you enter any trade, you define two numbers: your stop and your target. Let's say your stop is $100 below your entry. That's your risk. That's your R. Now you look for a target that's at least 2 times that distance. At least $200. That's a 2-to-1 risk-reward. Better would be $300 for a 3-to-1. Even better would be $400 for a 4-to-1. Here's the rule. If you can't identify a logical target that gives you at least 2-to-1, you don't take the trade. Period. I don't care how good the setup looks. I don't care how strong the signal is. If the risk-reward isn't there, you don't trade it. This one filter alone will transform your trading. Because most losing traders are taking every setup they see regardless of where the logical target is. They're risking $100 to make $100. They're risking $100 to make $80. They're risking $200 to make $150. And then they wonder why they need a 70% win rate just to break even. Let me tell you about a turning point in my own trading. I was trading breakouts on a day trading system. My win rate was around 45%. I was frustrated. I kept thinking I need to get better at identifying the right breakouts. I need to increase my win rate. I was trying everything. More indicators, better patterns, tighter filters. My win rate went up to about 50%, but I still wasn't profitable. Then I did something simple. I looked at my actual trades. Not my win rate, not my strategy, just the dollars. My average winner was $180. My average loser was $220. I was losing more on my losers than I was making on my winners. My risk-reward was inverted. I had it backwards. Even if I got my win rate to 60%, the math didn't work. I needed to win 55% just to break even. So I made one change. I stopped adjusting my stops. I stopped taking profit early. I let my winners run to predetermined targets and I let my losers hit predetermined stops. No exceptions, no discretion, no emotional adjustments. My win rate actually dropped. It went from 50% down to 42%. I was winning less often than before, but my average winner went from $180 to $320. My average loser stayed at $220. Suddenly the math worked. At 42% win rate with those numbers, I was profitable. Not by a little, by a lot. I was making more money winning 4 out of 10 trades than I was before winning 5 out of 10. That's the power of risk-reward. It doesn't matter how often you're right. It matters how much you make when you're right. Here's the part that most traders can't accept. You will have losing streaks. If your win rate is 50%, you will experience streaks where you lose 5, 6, 7 trades in a row. That's not a flaw in your system. That's just probability. If you flip a coin 100 times, you'll hit streaks of heads and streaks of tails. Same with trading. But here's the difference. With a proper risk-reward ratio, those losing streaks don't destroy you. Let's say you lose 5 trades in a row. At $100 per loss, you're down $500. Feels bad. Looks bad. But then you hit 2 winners. At $300 per win with a 3-to-1 risk-reward, that's $600. You just made back your 5 losses and you're in profit. You only won 2 out of 7 trades. That's a 28% win rate. And you're still profitable. That's the safety net that good risk-reward gives you. You can be wrong more than you're right and still make money. But it only works if you actually let your winners run to those targets. If you take profit early, you're back to needing a high win rate. You're back to needing to be right most of the time. And in trading, being right most of the time is hard. Markets are random. Setups fail. Unexpected news hits. You can do everything right and still lose. Trying to win 70% or 80% of the time is fighting against reality. But you don't need to win most of the time. You just need to make more when you win than you lose when you lose. Let's talk about the traders who actually make it. The professionals. The ones running funds. The ones making consistent money year after year. What's their win rate? Most professional trend followers have win rates between 30% and 40%. Think about that. These are people managing millions of dollars. These are people who have survived decades in the markets. And they're losing more trades than they win. How is that possible? Because their risk reward is massive. They're risking $1 to make $5. They're risking $1 to make $10. When they catch a big trend, that one winner pays for 5 or 10 losers. They don't need to be right most of the time. They just need to be right occasionally and let those winners run. Compare that to the average retail trader. The average retail trader has a win rate around 50% to 60%. Sounds better than the professionals, right? But the average retail trader loses money. Why? Because their risk reward is terrible. They're making $1 for every $1 they risk. They're making $80 for every $100 they risk. Some are even making less on their winners than they lose on their losers. They need a 60% win rate just to break even. And the moment they hit a normal losing streak, they blow up. Here's how you actually implement this. Here's how you stop sabotaging your risk reward. First, before you enter any trade, you mark your stop and your target on the chart. Not in your head. On the actual chart. You draw a line where your stop goes. You draw a line where your target goes. You measure the distance. If your target isn't at least twice the distance of your stop, you skip the trade. You don't take it. I don't care how good it looks. If the risk reward isn't there, you wait for a better opportunity. Second, once you're in the trade, you don't adjust those levels based on emotion. Your stop stays where you put it. Your target stays where you put it. The only acceptable adjustment is moving your stop in your favor as the trade progresses. Trailing stop, locking in profit. That's fine. But you don't move your stop further away to avoid a loss. And you don't take profit before your target just because you're scared. Third, you track this data. You keep a journal. Every trade you record your entry, your stop, your target, your exit. At the end of each month, you calculate your average winner and your average loser. This is your real risk-reward ratio. Not what you planned, what you actually executed. If your average winner isn't at least 1.5 times your average loser, you have a problem. You're either taking trades with poor risk-reward, or you're cutting winners and letting losers run. Either way, you need to fix it before you'll ever be consistently profitable. Here's the trap that catches everyone. You start implementing this. You start only taking trades with 2-to-1 or 3-to-1 risk-reward. You start letting your winners run to target. And at first, it feels wrong. It feels uncomfortable. You'll be in a winning trade. It's up nicely. It's approaching your target. And then it pulls back. It gives back some of the profit. Every instinct you have is screaming, take the profit now. Lock it in before you lose it. But you don't. You wait for your target. Sometimes it hits your target and you feel like a genius. Sometimes it reverses all the way back and stops you out at break-even or a small loss. And that feels terrible. You think I should have taken that profit when I had it. But here's what you're missing. You're judging individual trades. You need to judge the system. Over 10 trades, over 20 trades, over 50 trades. Letting your winners run to predetermined targets makes more money than taking profit early. Even though sometimes you'll give back profits, even though sometimes a winner will turn into a break-even, the math works over time. You just have to trust the process long enough to let the math play out. And that's the hardest part. Not understanding risk-reward. Not knowing what to do, but actually doing it when your emotions are telling you to do the opposite. Let me give you another scenario. You're in a trade. Your stop is $100 away. Your target is $300 away. Perfect 3-to-1 risk-reward. The trade immediately moves against you. It's down $50. You're thinking, this doesn't feel right. This looks like it's going to my stop. Maybe I should just cut it now and save $50. Here's what you don't realize. If you cut it at $50, you just changed your risk to $50. But you didn't change your target. You're still looking for $300 targets on future trades. So now your risk-reward isn't 3-to-1 anymore. On this trade, it's $50 risk. On your winners, you're still only making $300. You'd need to win significantly more often to compensate for taking smaller losses. You're mixing up your math. Here's the rule. If your stop is $100, your loss is $100. Not $50. Not $80. $100. You don't get to change that number just because you're uncomfortable. You defined your risk. You take your risk. If you're not willing to risk $100 on the trade, you shouldn't have taken the trade in the first place. The same applies in reverse. If your target is $300, you don't take profit at $150 just because you're nervous. You defined your reward. You wait for your reward. If you're not willing to wait for $300, you should have set a $150 target from the start and looked for trades where you could risk $50 or $75. At least then your ratio would be consistent. The traders who fail, and I mean consistently fail, year after year, they're all making the same mistake. They're chasing win rate. They're trying to be right more often. They're adding more indicators to filter out losing trades. They're looking for the perfect entry. They're trying to time the market exactly. And all of that might increase their win rate by a few percentage points. But it doesn't matter. Because they're still cutting their winners short. They're still letting their losses run a little longer than they should. They're still focused on the wrong number. The traders who make it, the ones who are still here 5 years from now, 10 years from now, they all understand one simple truth. Win rate is a vanity metric. It makes you feel good. It sounds impressive when you tell people. But it doesn't pay the bills. Risk-reward is the only metric that puts money in your account. You want to be profitable? Stop counting how often you win. Start measuring how much you make when you win versus how much you lose when you lose. Get that ratio to at least 2-to-1. Better yet, get it to 3-to-1. Then let it play out over enough trades for the math to work. That's it. That's the entire game. It's not complicated. It's not exciting. It doesn't require some secret indicator or magic pattern. It just requires discipline. The discipline to let your winners run even when you're scared. The discipline to cut your losers at your stop even when you think it might come back. The discipline to only take trades where the potential reward justifies the risk. If you can do that, if you can actually execute proper risk-reward consistently, you don't need a high win rate. You don't need to be right most of the time. You just need to be right occasionally and make it count when you are. That's how you win this game. Not by being right more often, but by making more when you're right than you lose when you're wrong. Your risk-to-reward ratio is everything. Your win rate is nothing. Get that backwards and you'll lose forever. Get that right and you might actually have a chance.